Stocks versus Bitcoin. Both are popular investment options today. Both offer the potential for financial gain, yet they are entirely different asset classes, each with their own unique benefits and risks. In this video, we look at some of the fundamental differences between these assets, including past performance, risks, future growth potential, and how to safely make them a part of your investment portfolio. Let's dive right in.
Stocks are an attractive investment option for a number of reasons. They have a long track record of relative stability, a good potential for growth, they offer the ability to easily diversify into different companies or sectors, and they are highly liquid, meaning they can be bought and sold quickly and easily. Stocks also offer an investor the ability to earn passive income through regular dividend payouts, in addition to the potential for an increase in the value of the stock price, otherwise known as capital growth. All these reasons make stocks a trusted asset class which investors are happy to dedicate a large percentage of their overall investment portfolio to. Bitcoin is a completely decentralized system, meaning that no central authority has control over it. This makes it a completely neutral, censorship-resistant asset class. No one can stop it or shut it down. It is not subject to government interference, red tape, prohibitive rules, or arbitrary restrictions. And these are all increasingly important qualities in a world which is becoming more authoritarian and restrictive with each passing day. Bitcoin has a fixed supply. There will only ever be around 21 million Bitcoins in circulation, and this cannot be changed. In fact, Bitcoin is the only asset class in the world with absolute scarcity, and this scarcity is a very important factor in driving its price appreciation over the long term. Bitcoin is also very liquid, making it easy to buy and sell if required. But unlike stocks, it does not offer the ability to earn income by default. That said, Bitcoin's incredible long-term growth rate more than makes up for this fact. More and more investors are realizing just how important and desirable Bitcoin is, not just from a price appreciation point of view, but also in terms of the preservation of their economic and political freedoms. And for all these reasons, Bitcoin has become an integral part of a responsible investment portfolio allocation.
Stocks, or more specifically the S&P 500 index, has seen an average 10-year growth rate of around 8 to 9% per year. Bitcoin has returned a compound annual growth rate of around 110% over the past 10 years, and this makes it one of the best performing assets in history. Now, if you'd like to compare the performance of these asset classes a little more closely, MicroStrategy has a really nice tool for investors. We'll put a link to their site in the description down below, but here it is. If you select the overview slider, you'll get a fairly detailed investment overview for a host of different currencies, precious metals, indexes, bonds, and the S&P 500 for the past 5 years. If you scroll down and hover over the S&P 500, you will see investment return data presented in a 1-month, 3-month, 12-month, and 5-year format. And you'll notice that the S&P 500 data is set alongside the Bitcoin data. Looking at the 5-year data, you can see that Bitcoin has produced over 3 times the investment return as compared to stocks over this period. Remember, serious investors don't concern themselves with short time frames, like 1 or 2 years. We have a long-term outlook of 5 to 10 years at minimum.
Now, it must be said that with the potential for greater returns comes the potential for price volatility. Although the stock market can be exceptionally volatile at times, and long periods of negative growth are very possible, Bitcoin is more volatile than stocks. And this is entirely to be expected given the size of the Bitcoin market in comparison to the size of the stock market, as well as the fact that Bitcoin is a brand new asset class busy undergoing capitalization. In fact, it would be exceptionally strange if it were not volatile. But as you can see from the volatility index, Bitcoin is around 3 times more volatile than the stock market over a 5-year period, and investors must be aware of this fact. Volatility is the price you pay for exceptional returns. But remember, you don't need to own a huge amount to start off with. In fact, we believe that new Bitcoin investors should start off with a very small allocation only, whilst they learn the basics of self-custody and continue to educate themselves. As conviction grows, volatility becomes less of a concern, because the investor begins to understand and believe in the future potential of Bitcoin. At this point, any significant price drops are actually viewed in a positive light. Investors get excited about the opportunity to buy cheap Bitcoin at a major discount.
If you could buy a brand new Ferrari for 80% less than market value, would you? Of course, because you know that a Ferrari is an incredible car and it's worth so much more than the price you're paying for it. It's up to you whether you choose to see Bitcoin's volatility as a good or a bad thing. But here's what one of the greatest investors of our time, Warren Buffett, has to say on the issue of volatility. As an investor, you love volatility. You love the idea of wild swings because it means more things are going to get mispriced. He also famously said, "Buy when there's blood on the streets." And this critical insight allowed him to make billions of dollars investing in quality companies for pennies on the dollar. Bitcoin's volatility allows an educated investor these opportunities more often than most other investments do. And in our view, as serious long-term investors, this is hugely advantageous.
When an investor purchases shares or stocks, they are awarded with equity in the company. So if you buy shares in Tesla, for example, you become an equity holder. And this means you become entitled to a number of benefits, such as capital gains or losses when the share price changes, dividend payouts when the company makes a profit, and shareholder voting rights. But it must be understood that buying stocks through a brokerage, as most investors do, means that from a technical perspective, your broker owns the shares. Very few investors bother with trying to own shares in their own names directly anymore, and this means that a third party stands between you and your equity ownership. Professional investors make a clear distinction between owning a paper promise and the underlying asset itself. Whenever a third party is involved, you can be sure that when it really comes down to it, you own nothing more than a promise, and promises are all too often broken, especially when economic conditions change or hard times fall on the third party. Bitcoin was created to, amongst other things, solve this very problem, the problem of having a third party between you and your assets. Bitcoin allows you to easily transfer ultimate ownership to the investor. When you buy Bitcoin, you have the ability to easily transfer ultimate ownership of the physical asset to yourself. Ethical Bitcoin exchanges will insist that you immediately transfer the Bitcoin into your safe custody when buying from them. Less ethical exchanges will encourage you to store your Bitcoin with them in what is called an exchange wallet. These companies assure you that your Bitcoin is safe with them, but history speaks for itself. More than 50 separate exchanges have been hacked over the years, and a great many people have lost their Bitcoin as a result.
In fact, whenever you hear about a Bitcoin hack in the news, understand that this is misleading. Bitcoin has not been hacked. The exchange has been hacked. An exchange is like a bank, a high-profile target for a thief. Hackers know that Bitcoin itself cannot be hacked. It's never been hacked despite people's best efforts. The only way to succeed is to target the Bitcoin exchanges, the bank where unsuspecting clients believe their Bitcoin is safe. There is absolutely no reason to entrust a third party with your Bitcoin under any circumstance, especially when taking self-custody is as easy as it is today. For small amounts, download an app like Moon or Blue Wallet on your phone. For larger amounts, you may want to get a hardware wallet to put your funds into cold storage. But always remember, buying Bitcoin the right way is a two-step process. Step 1 is the purchase on an ethical Bitcoin exchange. Step 2 is taking ownership of the Bitcoin, transferring it away from the exchange safely into your personal custody, into a wallet that you control. We'll put up a list of some ethical Bitcoin exchanges onto the screen now.
Stocks have traditionally had a reasonably high barrier to entry, requiring investors to have access to a broker and reasonably large sums of money due to restrictive minimum deposit requirements. Today, however, investors do have the option to buy fractional shares on platforms like Fidelity, Acorn, or Robinhood, for example. This makes the stock market more accessible to a larger group of people, since it's possible to invest smaller amounts of money. But as mentioned earlier, investors must understand the underlying risks that apply to these platforms. Their systems are subject to technical issues, outages, hacking, or dishonest business practices, all of which could disrupt trading and potentially result in financial losses. The stock market is also subject to limited trading hours. Stock markets trade during the business hours of the country in which it operates. This means that your money is completely inaccessible after hours, on weekends and on holidays. Because Bitcoin is traded in fractional units by default and available in tiny fractions from any exchange in the world, the entry requirements are extremely low. As a reminder, Bitcoin is divisible into 100 million units, or 100 million sats.
At the time of recording, a single US dollar buys you over 4,000 sats. This means that everyone can afford a few thousand sats. Bitcoin is available to billions of people worldwide, even those without bank accounts or without access to a well-established financial system, like those of us in the US and in the Western world are privileged to have. El Salvador, Senegal, Nigeria, Venezuela, and Argentina are just a few examples of countries where unbanked citizens are using Bitcoin as an alternative to the traditional financial system. There is no third-party exchange risk if you take self-custody of your Bitcoin as mentioned. And since Bitcoin operates 24/7, you have full and complete access to your money at any time. Not to mention the ability to purchase or sell Bitcoin at any time, day or night, weekend or public holiday. A simple smartphone and internet connection allows you the ability to safely own your Bitcoin. And this is a remarkable opportunity for people who have traditionally been excluded from the financial system as we know it.
In order to understand Bitcoin's potential future value, it's useful to take a look at the total size of the market as a starting point. The US stock market alone is valued at around $40 trillion. The gold market is worth over $12 trillion. Whereas the Bitcoin market is worth just over $400 billion, a tiny fraction of gold's market cap, around 3.5% to be more precise. Bitcoin can be compared with gold because they both share similar attributes and functions. However, Bitcoin is much more than just a digital version of gold, and therefore its ultimate market cap is likely to be much higher than gold's. In fact, it's more accurate to look at the market cap of bonds and global currencies to try to understand Bitcoin's eventual market cap. And bonds and currencies together are currently worth in the order of hundreds of trillions of dollars. Even if Bitcoin ultimately only absorbs a small fraction of these markets, its value will be substantially greater than it is today. The potential upside for Bitcoin, therefore, is far greater than it is for stocks or any other investment vehicle in existence.
So, should you invest in stocks or in Bitcoin? Well, that decision is ultimately up to you and your personal financial situation. Both assets have pros and cons, and how much weighting you place on each of those attributes comes down to your individual level of risk tolerance and investment goals. That said, remember that you can choose to construct your investment portfolio by applying the right weighting to each asset class you own. In other words, you can invest in both stocks and Bitcoin, for example, and apply a weighting that you are comfortable with. If you are more comfortable with stocks, you may choose to invest, say, 30% of your portfolio into stocks and only 10% of your portfolio into Bitcoin. You can increase or reduce those weightings to any number you are comfortable with. If you only want a tiny exposure to Bitcoin, say 1% of your portfolio, that's perfectly fine. The beauty of investing only a small allocation is that your downside risk is limited. Even if price drops dramatically, it'll have a minimal impact on your overall portfolio. But a very large increase in value could pull the overall returns of your portfolio up significantly. And always remember that you can adjust the weighting of your portfolio over time as you continue to learn and feel more comfortable. It's entirely up to you.
Thanks so much for watching. If you've received some value from this video, please consider supporting us by giving us a like and sharing it with friends. We have loads more Bitcoin related content coming out soon, so subscribe to the channel if you're interested in learning more. Thanks a lot and see you in the next video.